Welcome you all in my yet another session on CFDs. So I'll decode CFD part with one practical example so that you can understand the how CFD works in financial market and how CFD can be used for hedging purpose. So let's discuss about CFDs. All right. So I'm sure you would enjoy this session. So before go ahead with session, I would request you, please do share, like and comment to this and share this content with others as well. Because our main intention as a GMT Academy, our main intention to help people to understand the complex financial products. All right. So yes, of course, I'll decode this CFD product in this session. So the agenda would be basically to cover the introduction part, history of CFD, then objective. It means, as I said, so we want to spread awareness of this financial instrument so that people can understand, upgrade, even they can execute at their workplace and thrill, I would say, in their career. That's what we want. Anyways, then again we'll discuss about types of CFDs, different types, how CFDs works and all. Then top brokers, I'll tell you so that you can open your demat account or trading account with them if you want to trades. All right, and examples as well. And of course, Q&A, it means I'll just give one or two guess questions so that you can guess, or that guess questions may help you to answer, or maybe that the same questions you may expect in your interview process as well. So let's start with the discussion. All right, how CFDs works and all. So if I talk about CFDs, all right, CFD, it means contract for differences, which are financial derivatives that allow traders to speculate on the price movements of various assets such as forex, stocks and commodities without owning the underlying assets. So in futures, forwards, and options, what happens? So there would be one underlying assets, and you will get a rights as well. If you want to exercise that rights, you can exercise and hold that assets. But in CFDs, you don't need to hold any financial underlying assets. So it means you don't need to hold any stocks, commodities, bonds, or any other financial instruments. You don't need to hold anything. So here the game of differences. For example, let's say any stock price. Let's take the example of Wipro. Wipro stock price is, let's say, 420, which is current market price, let's say. And if you are expecting, let's say, stock price may go up to, let's say, 480 or 460, depends on your research, whatever research that you have done. If you have that research, then what you can do, you can open your accounts with, let's say, broker, because broker drive this entire event, CFD events. So you can open account with broker, pay the margin, maybe 10%, 20%. You can pay it, rest broker will pay it, and you can hold this particular assets. All right. So once you hold it, let's say if you are fortunate and price reach to 480, then of course you can execute from the CFDs and convert that whatever gain that you have in profit and take your profit back. So this is how basically market works for CFDs. All right. So you cannot mix CFDs with options or futures or other, let's say, forward contracts and all. So CFD is basically designed for only differences, price differences, so that you can gain the price differences and all. Now your question would be, sir, why CFDs? Why not options? Why not other things? See, CFDs which are quite customized, and you can take a huge exposure. You don't need to worry about settlement or physical delivery and all. That's what you can go ahead with CFDs, and you can deal in huge quantities also by paying very small amount. So I have designed one example so that will help you to compare between, let's say, the CFD product and other products as well. All right. I hope now you got the idea about what is CFDs and all. If I talk about now what is CFD trading, but before that, I would like to quickly walk you through about history of this particular product, when it was came into existence. See, first time CFD came into existence in the year of 1990. All right. CFD came into existence in the year of 1990, and it was first time launched in London market. All right. So where initially the purpose was, and even it was allowed for hedge funds only, hedge funds and institutional investors, and it was trading without paying stamp duty to the government. All right. But anyways, so now this particular CFDs is allowed to the retail investors as well. If you want to invest, you can open account with reputed brokers and you can execute your trades. Now, if you talk about brokers, what are the brokers and all? So there are different brokers like AFP market, that facility or platform also offer, let's say CFDs, XTB, then ava or ava something that you can say trade, that market also offers CFDs. Then eToro trading platform that also offers CFDs, and famous or popular one you can say Saxo Bank, that also offers CFD facility. Recently, I have opened my account with Saxo Bank. I just wanted to, try the CFD product, and I just wanted to figure it out like how the CFD products are different from the futures and options. All right. So, yes. So as I said, if you talk about history, it was first time launched in 1990 in London market. And if you talk about brokers, as I said, you can note down these brokers and you can open your account with all of these brokers, deposit small amount of money, and then you can start trading with CFD products. Now, let's talk about how or what is CFD trading it means. CFD trading is between trader and broker. As I said, CFDs are broker driven. So broker eventually execute all of this. In options and futures, now I'll give a guess, how you can guess and all. So this statement is very important. CFD is a contract between a trader and a broker. The broker agrees to pay the difference in the prices of an assets between the open and closing trades. Again, very important one. The contract doesn't involve ownership of the underlying security. So it means you don't need to hold any securities as such, which means CFD trades are exempt from stamp duty in UK. Traders can open buy or sell positions when they trade CFDs based on which we think the market might move. So depends on your speculation, depends on your trading strategies, depends on your research. If you see, let's say you have any research which says like market will go up, you can then sit on buy position. If your research says, let's say market goes down, then you can sit on sell positions. But yes, everything is depends on your research. And if you ask me the trading pattern is very simple. So it's like a future trades. You can open accounts with reputed brokers, you can deposit margin and enter in CFD contracts, execute the trade. That's all. All right. Another key feature of CFDs in the use of leverage, the trading with leverage, also known as trading on margin, allow traders to put up only a small portion of the full amount of the trade to open a position. Trading on margin amplifies potential profits and losses equally. So it's essential that traders understand and manage risk. So ultimately, even if you pay margin, but if let's say your trade goes in huge losses, so you will have to pay entire losses. That's the difference, key difference that you can differentiate from the your future contracts. All right. So now next, let's say how, because everyone is, I'm sure everyone is curious about how your how does CFD trading works. All right. So with CFD trading, you can buy or sell units of financial instruments depending on whether you think price will go up or down. So as I said, it depends on your research, depends on your speculations and all. To illustrate this idea, let's take an example. One of our most popular instrument in the UK is UK 100. So basically it's indices. All right. So again, if you talk about types of CFDs, let me just amplify it. You can buy CFDs in stocks. Note it down, this one, in index, currencies, Then your commodities or any other, if you see, that you can buy and sell the CFDs for stocks, index, currencies, and even for bonds and even structured notes. Also, if you have, you can do the same thing. Means you can enter in CFD contracts. Depends on the brokers. If they have any facility as such for those, you can enter it. All right. If you talk about UK, it's index, which is based on the price movement of all stocks listed on the stocks, FTSE 100 index. It's like, let's say in NSE, we have a Nifty index, right? So Nifty like bank Nifty, and also we have index. So same way you can see UK 100 and UK FTSE index. All right. Imagine that you have carried out some research, as I said, and you expect the index to rise in the value. You therefore place buy trade on the UK, let's say 100, right, which is index, and for every point that the price of the UK 100 moves in your favor. So basically you did research, and now that particular trade is in your favor, so it means you gain the multiples of the number of CFDs units that you bought, and for every point the price moves against you, you make the losses as well. So it's like normal future and option trades, because in futures and options what happened, we purchase units, and again against your units, price of that particular units that will move in market. And if the price, let's say, move in positive direction, you would be in profit. If that moves in negative direction, there would be a loss in your position. So same logic you can apply it in CFD trading also. I hope now you got the understanding of CFD trading. So we have other examples as well. So let's discuss that in details. Now, see, same example, if you carry forward and if you just put a logic, how CFD, how does CFD trading works? Let's assume it, you have open account with, let's say, Saxo Bank, right? And you have purchased, let's say, UK 100, right? 100 quantities, 100 quantities, let's say here under UK 100, right? Or maybe let's say 10,000 units, assume it. You have purchased it. You have enter in buy position. You have entered in buy position. Let's say you have entered at this point, price was 100, and now as per your research, the trade is in your favor. And here you have decided to take an exit. Just imagine you sold at 1110. So you have a profit of 10 points. And if you multiply 10 points is equal to, calculate your profit, whatever profit you have. Here we are talking about pins, it means it would be in 1000. And why there is a profit of 979? Because they have charged some interest payments and commission also. So that will be, of course, it will be deducted. And after that only net profit will be credited in the books of traders. So this profit you can withdraw it. So this is how your CFDs works in market. This is how CFD works in your broker account. And basically CFD is a OTC product. OTC, it means over the counter product. CFDs are broker driven, not the clearing agents or centralized counterparty driven. Make this clear. All right. So let's take the another example as well to understand in very detailed. So here I have an example so that I'll decode. Let's say. So now if we talk about, let's say I have designed this, trading example for a trading, how trading leverage works and how non-leverage trading works. Let's say you have one, security, any security, let's say price of 100 euros per shares, right? Number of CFDs that you have decided to enter is around 10,000. All right. And total value of the trade is, so basically again, $10,000. So now in this case, if you see the deposit which we required to enter in the contract is deposit, it means margin basically that will pay, which is 20%. Again, this margin rate which is not fixed. it will vary from different broker to broker. Maybe Saxo Bank is charging 10%. Maybe let's say other FP market is charging around 20%. So that percentage will vary. So it's not a fix because OTC market is not a regulated place. So it means it will vary, depends on your relationship with the broker, depends on financial instruments, depends on that size of the contract, depends on all other factors. But 20%, I would say it's a generic one, so that you can deposit. So basically 10,000 into 20%. So $10,000 or K, 10K is the total size of the contract. And here broker will ask you to deposit 20% deposit in CFD account. Once you deposit 2,000, then you can enter in the value of 10,000 or 10K CFD contract. So this is how you can leverage out. Then who will pay remaining amount? Of course, broker will provide funding. So it means broker will give you loan of 8,000 so that you can take the full position in that particular CFD contract. All right. Now, if you compare this one with the non-leverage deals, see in the non-leverage deal, same trade, you will have to pay 100, let's say, dollar at means price per unit, whatever unit that you have, number of shares value. If you purchase it, let's say 10,000, and total value of the again deal is, let's say, entire value that you have decided to enter is 10,000. So here 100% deposit is mandate. So you can pay 100%, which would be around 10,000 or 10K euros that you can pay to buy the holdings. That's how you can differentiate. So it means CFDs will allow to take a huge position in the market and to multiply your profit. But anyways, if you take a huge risk or a huge position, then it means that will lead to the huge losses as well. So while dealing with CFDs, make sure you have done the research and frameworks and everything, and then only you can enter into the CFD products. All right. So let's continue the next, same example. So we'll discuss in details with this. All right. So we'll discuss the same example. Same, it means only this example will continue this example and will decode with the profit and loss situation. So we have a scenario where for a profitable trades, how we can calculate or compute profitable trades in this example. So let's see. Let's assume you have a prediction or your prediction was correct, and ABC, let's say, stock that rises over the next week to sell price at 1110 and buy price, if you see, around 112, right? You purchase at 1110 and sell price which is 1110. You close your buy trades by selling at 1110 and commission is charged, which is 1%. As I said, commission and everything, it will be charged. So around 9 euros, whichever is greater, let's say that commission is charged. And when you exit a trade too, so charge of 11 is applied at that point. So it means when you buy it, at the time of buying also commission will charge, and even at the time of sell also commission will charge. So total units you have, which is 1110 units, 10,000 units into basically your 1110 is the price of that particular exit contract. All right. Sell price, which is 1110. All right. So total exposure, it would be around 11,000 or 11K euros into that your commission percentage. So it would be around 11 euros that we have calculated. All right. Then the price has moved 10T in your favor. So after you enter in that particular trade, so price, let's say, went up, and from 100 to maybe let's say 1110, and the current sell price or the closing price of the CFD is 1110. So now if you multiply this price rise by the number of units you bought, which are around 10K, the calculate your profit, which goes around 1,000 euros. Then subtract the same total commission charge, which is 10 euros at entry plus 11 at exit, as I said. So 21 would be your commission, so that you will have to pay. The result is total profit goes around 979 euros. So which you can again means minus overnight cost of holdings and everything. So this is how you can compute your profit in CFDs. So basically this was the scenario for profit, and which we have already uh, discussed in the chart as well. So you can go back, and we have, this is on chart as well. So just see this, how we have calculated profit. So this was the case of when the price up and you were sitting on long trade, basically buy trade. You purchase at this level, sell at this level. So profit would be around 1000 euros. But basically again, the commission or charges that you will have to pay it around 21 in euros. So net profit, if you can calculate, it goes around 979 euros. So this is how you can calculate the profit and losses from the CFDs contract. So it's like a future trades only. So you can relate with future trades. All right. So now we'll take the another example for a loss. So let me just walk you through, in case of losses, how we can compute it, or how you can relate that losses with the CFD contracts. So same example, if you see, let's take this scenario. Assume you are wrong, means your research were wrong, and the price of ABC drops for the next week to sell, right? Price which is at 93 paisa, and a buy price of, let's say, 95. So basically you purchase at 95, and now price which is at 93. So you think the price is likely to continue dropping. So to limit your losses, you sell at 93 paisa to close the trade. A commission fee again 0.01% at the time of buy, and again same at even sell as well. So which is payable when you exit a trade. So charges of 9.30 euros which will applied, let's say, which is already applied. All right, let's compute the fees. How you can compute the fees? 10,000 units into 93 paisa, it goes around 9,300 euros into 0.1%, which is percentage of commission. So 9.30 euros would be your fees. So that broker will ask you to pay it. And additionally, the price has moved, let's say, 7 paisa against you, right, from 100 paisa. So the initial margin, if you just calculate it, then you can relate. All right, total units which you know it. So you enter at, let's say, 10 at entry plus 9 0.3 at exit. So total fees that it will be generated around 19.30. So that you will have to pay this to the broker. All right, and the result is total loss of 719.30 plus overnight holding cost. How we can calculate this? I'll help you to calculate your losses, how we have raised it. So see here, we have calculation as well. See, you have entered at 100, and the current price which you have sold at 96. All right, so total loss 7 paisa or peons, that you can say. Total units you have is 1000 units. So just multiply it into 100, and same into 96. Let's calculate it, how much it would be. So it goes around 96 plus this one. So around 1000, 71.7 sorry, 719.30. So that would be a loss. So you can exit at this and get out of this trade. All right. So this is how you can compute your losses basically in this CFD contracts. All right. Let me just compute 10,000 into 0.96. 9,600 for this one, and 10,000 into 10,000. Let me just quickly calculate back. So 10,000, which is the unit, or 90 paisa, it goes around 93,000. Then here basically we have nine total loss of 793. So how we have reached to this 719, which is your basically fees which we have added. But what about this 700? How we have calculated it? Price which is reached from ABC to buy. Okay, this one price which is buy price which is 93 and sell price of 93. So basically two paisa difference that I can see. And you think price is likely to continue dropping, so limit your losses. So you will sell at 93 paisa, and to close the trade, a commission which is 93, that's fine. And payable when you exit a trade, so charge 9.30 is applied. So 1000 units into 93 paisa is equal to 3,000. But when we say 100 paisa, so it would be around then 10,000. How did they calculate it? So 0.01 paisa, which is 93, and the price has moved 7 paisa against you from the 100 paisa. Okay, so basically 100 into, got it. So 7 paisa, so it would be around 700. So price which has moved 7 paisa against, let's say, my trade. So 700 plus, so this fees 9 plus at exit plus entry, which goes around 19, plus 19, which is broker charges. So it comes at 719.30. So that's how you can relate 71930. So basically 7 paisa. So this particular trades, let's say price change against me 7 paisa basically. All right, but in chart it seems in a different way. So I got confused little bit. 7 peons, the price changed 7 peons. So basically the position or quantity was around 1000 into 7. If you just do it, so it goes around 700 plus charges of this 19 broker charges. So total loss would be in your trade is 719.30. All right. So this is how you can see your losses and profit in CFDs. Same logic you can apply it in your trade or system wherever that you work. Maybe let's say you're working as a let's say analyst at broker level, or maybe you're working as accountant at fund level, or maybe you're working as a settlement analyst at prime broking level. So you can apply this logic. You can go through this session and you can compute broker profit. You can also calculate the profit and losses by applying this logic. So I'll take one more example to see how we can hedge the position with your CFDs, and how you can how you can effectively hedge it. Because most of the hedge fund managers and even traders, they apply the logic and hedge their positions. All right. So again, question maybe you can expect in your interviews: how do you hedge an existing portfolio with CFD trading? So assumption is you're holding physical shares, or you're holding shares in your demat account by paying full amount. So let's say you're holding Tata Motor shares in your portfolio. So you have total 1000 shares with 400 price, and current market price of the Tata Motor shares is 920 rupees. So total portfolio value you have is 9,20,000. See, when you have total portfolio value 9,20,000, and you see your main now concern is, what if price, let's say, moves or down, let's say from 9,20,000 level. What if that price down? So you would be in loss eventually. But how you can mitigate that loss? See, CFD is not only one option. There are many other options as well. So which I know it. Maybe you can buy, let's say, put option. Maybe you can buy future. You can sell future. Maybe you can short sell securities as well. If you're worried about it, you can short sell for a time, and you can, recover that your losses as well, portfolio losses as well. So there are a number of strategies. So it's not only that CFD, it's not a one option, right? But anyways, CFD offer other benefits, and that's what they only enter through CFDs and all. So let's say you're worrying now, what if due to the volatility and all, my price or portfolio price may goes down from the 920 level. All right. So that's what you have decided to enter at 920. All right. Let's say if, as per your research, if you enter at 920 and if price goes down to, let's say, 820, so here in your portfolio you would see loss eventually. But in your CFD contracts, so you can open CFD here, right? You can close CFD here and you can book profit. So profit which would be around 100 rupees or maybe dollar for per shares. So eventually in your profit, you will have a loss, and in your CFD position, you can book the profit of 100 rupees for per unit. So you have total, let's say 1000 units into 100. So let's say it goes around 1 lakh profit that you can book in CFD, and 1 lakh loss that you can see in your portfolio. So this is how you can hedge your portfolio. All right, so I have a calculations, I'll quickly walk you through. I have already covered that in my next slide. So here you can see the calculation basically. So we have a calculation. See this total portfolio, in portfolio you would see loss of 1 lakh. Why? Because price, let's say, which has been changed from 920 to 820. So assuming that you have entered or open your CFD positions, which is at dot 920 level. So you have opened the positions, and hold period means, let's say you have hold it for 1 month, 2 months, 1 week, 2 weeks, whatever the duration that you wanted to hold. Let's say you have holded this particular CFD and you have closed here. So once you closed here, let's say you have closed at 820. As I said, 920 into 1000 if you calculate, so it goes around 9,20,000. All right, and current market price of CFDs, if you see, 820 into 1000, which goes around 8 lakhs. So profit you can book it around 1 lakh. So you in CFDs you can book the profit which is around 1 lakh, and in portfolio you can see the losses of 1 lakh, so which will tie. So it means hedge, it means to protect your portfolio from the market volatilities or protect your portfolio from the risk. All right, if you see any risk in your portfolio, so you can protect your portfolio from the market uncertainties. And if we talk about here CFDs, here we are doing basically short sell in CFDs. So you can sell at 920 and you can cover your positions at 820. You can buy it back at 820. So this has become your short, short selling of CFD positions in market. All right. I hope you got this now, how you can hedge your position, how you can protect your portfolios from market uncertainties. And same now you can try with your portfolio as well. So see, this session will help to the fund accountants to calculate the benefit of CFDs. Even it will help to the reconciliation analyst who want to reconcile their portfolio. And also the session will help to the fund managers and traders who are dealing with all of this CFD instruments and all. So I hope you got this, my entire content about CFD hedging and types of CFDs as well. All right. So I'm done with this session. So now I just would like to give you one guess questions. So if you want to just guess it, so just try with this. You can also post your answer in comment section. So let's take these questions. Can you tell me the difference between CFD and futures? So tell me key differences between CFD and futures, because we have discussed about CFDs, how CFD works, how trading works, and in 60 to 70% cases you would see similar sort of features means future features with CFDs. So now just tell me the two to three key differences between CFDs and futures contract. So you can try to answer that in comment section if you if you want. All right, I'll verify it and I'll answer. I'll means acknowledge and answer those as well. All right. Otherwise, I'll take this in my next session. Meanwhile, you can watch my other sessions too. And if you're looking for such a content, or if you're looking for courses as such, I would request you can enroll my fund accounting program, or let's say even other programs also we have for trade processing, recon, hedge fund, private equity, mutual funds, ESG frameworks, and also we have a trainings basically. So the trainings will help you to understand financial products in details, their workflow, processing, brokers, how they work, their key terminologies, patterns of trading. Everything means everything in details and in a very layman language, I would say, which you can understand it. If you are looking for that, you can contact us. My team will help you to understand the curriculum and course content, and they'll also help you to get on board as well. So far, we have helped around more than 5,000 plus students